This is going to be part 2 on my process for coming up with trade ideas. The example I'm going to be going over is this day right here, where we dropped down into a discount, taking out these sell side draws before running up to our buy side draw of this previous day high. So the drop down is the short idea, and I'm going to go over how I would go about coming up with it and the process for it. So to start with, we always start with a framework. And first I'll just explain all the 3 different steps, and then I'll show how it fits in with this example. So a framework is the structure / pattern that already exists in price with data that gives an expectancy of a specific outcome. So in essence, it's something that you aren't expecting to happen, you aren't anticipating anything, it's something that you can clearly see. This usually comes in the form of some sort of price pattern or thing that you've seen repeat in the past. You can say that this is the probability at this percentage of time we'll see this certain thing play out. A few examples of this could be this one here, where I call it the 8:30 no soup. So let's say this is the 8:30 open right here, and this would be on a indice. Oops. So 8:30 opens and we expand in one direction without running any opposing liquidity. That's also from anywhere from 8:20 to 8:30. As long as no highs were run within that time period, then that's what I expect to play out, is that the 9:30 will run straight back to the 8:30 pull. So let's say this the 9:30 open just here, 9:30, and yeah, my expectation is that we'll run up to that. So that's a framework, is that I have a certain expectation based on what exists in price. This is clearly existing in price because let's say we come to the charts around here, we can see that we didn't get any soup of opposing liquidity going into 8:30 and we expanded in one direction. So that's the first example. The second one could be trailed stops. So I'll give a bullish example this time. Let's say we have a really large up move and then we just spend a bit of time in here and then have a continuation higher. Now at this point, you're thinking, okay, whoever saw this big move, they're going to want to get long. Where are they going to put their trailed stops? Well, maybe down here, but maybe this is a bit too shallow. Maybe you're expecting it to go a bit lower. Maybe traders are waiting for a nice, strong looking low to trail the stops to. So let's say we pull back a bit, engineer a really nice, obvious low, and then pull up. Now my framework can be, okay, I want to see this low targeted for trailed stops. So we might get a pattern and then I can target that low, and that could be another framework. So I have an expected, I have a certain percentage of expectancy that we should go down and take out this low, having engineered it for people to trail their stops to. The third one I will give would be a failed bull flag. This is one I really like to trade, especially on gold. So let's say we are bearish, we engineered a really obvious low and run up and then start consolidating with a classic bull flag pattern. Then at a certain time, maybe we get a run up, trip the highs, and then begin to break down. Then I can have a certain expectancy that we are likely to take out this low. I don't know what percentage, but maybe 70% of the time we will take out this low rather than go to the highs. So that can be another framework. So this is always the first step in coming up with a trade idea for me, is coming up with a framework. This ensures that I'm not form fitting price to what my bias is. So if in this scenario I said, okay, I'm bearish on the day, then I look at the price and think, okay, maybe it's a pullback into this fair value gap to go lower. Or if in this scenario, I think, okay, I'm bearish on the day, then maybe I would have some different expectation, and then I'd be looking at price thinking, okay, well, I want to see it do something else, rather than looking at what actually exists in price already. So already I can see a real pattern that exists and I've seen before, and then I can see how that fits in with the bias and narrative, which is the next step. So for bias and narrative, there are three parts to it really. The first is the high time frame draw on liquidity. So where price is going on the weekly and daily chart. So that's essentially where you have, let's say, a old high or an old low, and we're expecting price to go up to this level. So if I expect that price will go up there and we're sitting here, then I want to see if price can go up to there. That's my bias, but we aren't there yet. So we're sitting around this area. I want price to go up there. The narrative is how price will move to that higher time frame area. So if this is the daily chart, I'll copy that and move it over here. The narrative is, okay, how is price going to go up in one direction to there? Or is it going to do something like this, like maybe engineer a short-term low, rally, take out that low, and then move up, and then pull back into a fair value gap, and then from there go up to the draw. So that's the narrative, the story on how price will move towards that draw. The third thing is the sentiment. So how price prints in a way to induce liquidity at advantageous areas that make it obvious what side the market is offside. So that's, for example, if I grab this and move it over again, we can see that in this area we had this rally and then we engineered a short-term low. We then enticed higher, so continued to move higher. So there will be liquidity building up down here. So it's inducing liquidity at an advantageous area because they want to, smart money will want to accumulate these stops. So by rallying up like that and then breaking down aggressively, maybe the sentiment's changing on the low time frames. If it looks like it's very weak, looks very bearish. And when you have the understanding that we are going up to this green line and we are hitting a key pool of liquidity that's advantageous to accumulate for the purpose of going higher, then yeah, that's what you're looking for. So that can be seen on many different time frames. It can also be when you zoom into even lower time frame, you might see something along the lines of, let's say we're bullish and we get a really big up closing candle that closes as green as possible. So ultra green closure. And then the very, very next candle runs straight back down and takes out the previous candle low. Like that. And following this, we take out that low, and then the very next candle we start moving higher, get us change in state of delivery, and then run up. So what you could see this as is maybe we already had some relative equal lows down here. So something like along the lines of that, really aggressive move back down, and then we take out that sell side and run up. And how this would fit in with the idea of sentiment and making it obvious what side of the market is offside is if we can clearly see that they've had these very large enticing candles higher to try and engineer and induce more liquidity to be resting at this particular level. And then when we aggressively move down to take it out, then I can have the narrative of, okay, well, everyone who was looking to go long would have got long on these big up closing candles, likely would have accumulated a large pool of sell stops down here. And then when we have this drop back down, taking out that previous candle low, and then push our way back up, then I can assume that we've accumulated this liquidity. Whoever's been wanting to get long, they won't want to get long anymore, especially with this high resistance. And also whoever's short who was enticing this down move are now going to get squeezed. So that's kind of it's kind of like narrative as well, but on the lower time frame. So that's part two. So to recap, the first part is the framework, looking for some sort of structure or pattern or some reason to expect a certain outcome. It could also be a news item, like a fresh news catalyst that gives you a certain expectation on price. Then we go to the bias and narrative, and we want to see how the framework fits in with the bias and narrative. And how that would work, for example, is let's say on this day where we engineer this low, rally high, and then take out that pull. So maybe we're bullish on the higher time frame, but then we get this pattern. So maybe this failed bull flag pattern happens right in here, and I know that I want to target this particular low, and that fits in with the higher time frame narrative because we're going to take out old lows before hitting higher. So I can trust catching a short because it fits in with my high time frame draw up to here, and it gives the narrative on how we would get there. So once I've got those two things dialed in, then we move to the third one, which is the entry technique. And this is really just any particular price model that allows you to clearly define risk. So I'll give a few examples of some that I like to use. One would be the failure swing. So let's say I'm looking for a short. We have some buy side taken. We drop down. We take out the sell side pull. We take it out again. And at this point, we get a really nice push up. So once we get this strong push up, we've taken out this low. There's no way you'd want to see this taken out again if we are bullish. So if we then start breaking down towards it again and we close below a discount array, so disrespecting a discount array down here, then I'd see that as an entry and expect an expansion away from it. So I'd be placing my stop. You enter as soon as we close, expecting quite an aggressive move. And usually it's quite fast, so you just want to enter on that candle closure and then stop above the failure swing high. Failure swing as in it failed to go above this high. We don't necessarily need a high in between, but yeah, so that's the first entry model that I want to explain. The next one could be an old high slash old low. That's essentially where we have, let's say, a low that was engineered. We then take out that low, run back up, and then run back down and swoop below that old low. That can be an entry technique and then expecting a move higher. So I'd be looking at the old low and expecting us to, so long how these are always so big, getting in at that old low, and then that's my way of defining risk and finding an entry that gives me a good risk reward. Then to go on to a third one, we could have a third pattern, which would be, let's say, a wick soup order block. So this is where we have a candle with a nice long wick that's engineered. Let's do that. So nice long wick that looks like a strong rejection. And then we close, I'll make that green actually. And then maybe we consolidate a bunch. And then we head down very aggressively and take out that soup, that wick once again. And then after following that, we then have a lovely move straight back up. And then you can use the order block. So with this particular model, what it's essentially saying is that we've got a really obvious low that we engineered where we can assume that anyone looking for bullish price action, they're going to think, wow, this is a really strong rejection. There's no way price can get back below this wick. And so people's stops are going to accumulate within this range. So anywhere within this wick's range, stops are going to accumulate. And then when price works its way down, takes it out, a really obvious liquidity pool that was clearly engineered in a way that induces longs into the market. So people think this is really strong rejection, and so that it's inducing and enticing longs. When we take that out and then get a really nice reaction, I can use that order block as an entry and expect to move higher. So that's just a few examples of some entry techniques. And to recap again, starting off with the framework, a clear structure that exists in price that I can have an expectancy on a certain outcome and have data behind that telling me what percentage of time. Then we go on to the bias and narrative and how the framework fits in with that bias and narrative. And that's where we think price is going on the daily or weekly charts. The story of how price will reach there rather than in one straight line. How is it going to get there? Then the sentiment, and that's basically what is the general sentiment about the market and how is that fit in a way that's advantageous for inducing liquidity at advantageous areas that make it, and also make it obvious what side of the market is offside. So that's also key, is make it obvious what side of the market is offside. Finally, from there we go into the entry technique, and that's just whatever thing I can use on the lower time frame that allows me to frame risk. So heading back over to our example, we can start off with the framework. So the framework in this particular example, let's say, so this is the trade I'm looking at. And what I want to do is be going on to, probably don't need replay mode. But yeah, overnight we see this big rally going into the close. I know that we've got all these smooth lows below. And what happens overnight is we drop back down into the range. We've got a new day opening gap forming up here. And we just grind down towards this low. Now what stands out about this low is it is a impulse low. There are no obvious pulls anywhere from here up to the highs. And so we can assume that all the liquidity is resting down here. So this is my framework. My framework is that we have trapped longs, and I call this the knife twister model, where I expect us to draw down towards the really obvious low where I know stops exist, and it's the only place that was in this entire run that had stops. So that's the framework. The other part of the framework is, if we look out again, we had this big up move and no trailed stops have been taken. So this was on a Thursday, and then on the Friday we engineered this low. So this is a previous day low, the Friday previous day low. And so we engineered a lot of smooth lows down there, a bit of consolidation, and then rallied higher. So we can assume that trailed stops have accumulated below this low. So the other two frameworks we got the sell stops down here and targeting the sell stops down here. Next step is the bias / narrative. So that was the framework. And now we can go to bias and narrative. And bias and narrative, we're essentially looking at where do we think it's going? Well, this was the very obvious low-hanging fruit objective. This previous day high sitting up here, really obvious buy side pull. Impulse high before this drop down as well, enticing shorts. And we're clearly pushing up in towards that level. So That's where I think price is going on the higher time frame. How will we get there? Well, we're likely to take out sell stops and then go up, which fits in with the framework of us taking out the trailed stops down here. And then thirdly, the sentiment. You can see that we've been engineering all these smooth lows. We can assume that people think, this is a trend line or something, and there should be liquidity building up below these lows. You've also got all these enticing rallies there, there, and there, and there. So a lot of enticing rallies higher that you can assume people wanting to chase. And then the last part of the sentiment, if I drop to a lower time frame now, so I'll go down to 5. So how price prints in a way to induce liquidity at advantageous areas that make it obvious what side of the market is offside. So we want liquidity below these lows. You can see that we drop down and engineered smooth lows down here. So part of that is people see this as strong support. We've got all this price can't really get below this level. The next part would be engineering liquidity in a way that's advantageous, and that goes down onto the low time frame. Things such as having this rally and then a failure swing lower and then continuing to push higher, enticing longs, but then failing to take out this high and aggressively dropping down. So you can assume that we've got people who are trapped long, not only from this run up, but the second run up, and are now under order. So that's a few things to use for that. And then going to entry techniques. Obviously, the whole time you're looking for other confluences. One that was really nice with this particular trade is that we had really nice, easy SMT to see, which is our divergence on the highs, telling us that we're likely to head lower with the high of day. So this is the high of day. You can see that NASDAQ actually took it out. Whereas on ES, we can see we actually failed to take it out. So we made a lower high. When that happens with a key high of day, that's really stands out to me. And yeah, that was the case here. Then we can drop down to a lower time frame and find our entry. Lows, there we go. So in the lower time frame, we want to see, okay, we've had this run up, we then have a failure swing, an aggressive drop back down with displacement. That being really key, that we had an aggressive move down. And we can look for a premium internal range to sell above, such as this. So anywhere above this line, we might use the old high that we souped. So if you draw this out here, you can see that this was the buy side pull that we engineered before running up and taking it out. So you could potentially use that as a soup entry and trust that we shouldn't go above this failure swing high. Or if you have another example in here, or another one that I thought was quite cool that I didn't take. I saw it. I didn't quite have the confidence to take, simply because, I could tell it was heavy, but I didn't have a way of getting in right down here. But in hindsight, I can see that what I could have done, given it the opportunity to run up to a premium in here, so it could always run up like that and then dump. But then when it fails to do so and actually gets this displacement lower, then I can look to enter at any short-term premium. So we haven't had a premium there or there, but once we get to here, I can sell in this area, trusting we shouldn't come up here, and trusting that this is a balanced price range. And with the heaviness of price, we should just keep on pushing down towards that low. So that could be my particular entry model for getting in, is just selling within this lower fair value gap. And you could even potentially define risk with the midpoint of this wick, expecting that should hold price as well. And yeah, that pretty much shows how you can go from coming up with a framework to seeing how that fits in with the bias and narrative, and then finding an entry model. So the framework being, we have the knife twister model with this impulse low that we made red vehicle lows with. Then we pull back to a premium of this range. And the framework also being that we're looking to target trailed stops after this big up move. That fits in with the narrative and bias of us heading up towards this buy side pull. And so that's the bias, and then the narrative is that we will go down to take out stops and then head up to the draw. And then dropping down to the low time frame and finding the particular price model that allows me to define risk and find an entry. So that will do for this particular part of the video. I think that's a pretty good summary on how I come up with trade ideas and make sure it fits in with what I'm expecting, and then find an entry to use to play that model out.